Hi, my name is Nofati Halyana binti Ismail. My magic number is 01 DKB 23F1006. Now I will explain about the financial stability. Financial stability means the banking and financial system can function efficiently even under stress to provide essential service like lending and payment and withstand shock or crisis without collapsing. For another point is maintain public confidence and trust in the system. A stable financial system supports economic growth and avoid disruption that could lead to financial crisis. Regulation is important because it helps stop financial crisis to protect people money in the bank. It also makes sure that banks handle risks like bad loans or sudden change in the market. Regulation helps prevent banks from fail. If one bank fails, it can cause big problem for the whole system. That's why banks must follow certain rules. These rules help banks manage different types of risks. For example, they must be carefully when giving out loans, dealing with the market, or running daily operation. Regulation also help people trust the banking system. When people trust bank, the economy become more stable. Banks must also follow international rules such as the Basel Accord. These rules give guidance on how banks should manage money and risk. In short, regulation makes sure banks have enough money saved, understand their risk, and are ready for bad economic time. Without these rules, one bank's problem could spread and hurt the whole economy. Now, I will explain about the bank structure and how the risk event affected the bank. Banks have three parts, which is asset, liabilities, and capital. Assets are the things that bank owns like loans, investment, and cash. Liabilities are what the bank owns such as deposit and debts. Capital is money from the bank owner acting as a safety buffer. Bank face risks like loan default, market crash, or fraud. This risk cause the bank to lose money, which lower its profit and capital. If the loss are too big, the bank might be not enough money to pay back customer. This causes liquidity problem and can hurt the bank's reputation. Regulator require banks to manage risk carefully and keep extra capital to handle unexpected loss.
Hi and Assalamualaikum. My name is Nur Ain Kamila binti Kasri and my matrix number is 01DKB23F1029. Today, I'll be presenting the Basel regulatory framework which include Basel 1, 2, 3 and 4. These frameworks are essential for managing risk in the banking industry and are highly relevant to our subject, risk and compliance. Let's start with Basel 1. Basel 1 focused mainly on credit risk. It introduced the idea of capital adequacy ratio, which required banks to hold at least 8% capital based on their risk-weight assets. Assets were divided into categories with different risk weights. For example, 0% for cash or government bonds, 20% for interbank loans, and 100% for corporate loans. This helped ensure banks had enough capital to cover potential loan loss. Basel 2 expanded the focus beyond just credit risk. It introduced the three-pillar approach, which is the first pillar is covered credit risk, market risk, and operational risk. Banks could use either the standardized approach or internal rating-based IRB approach for credit risk. Second pillar is give supervisors more power to assess banks' risk management processes and capital needs. And third pillar is required banks to publicly disclose risk and capital information to encourage market disciplines. This version allowed banks to tailor their risk models but also made the system more complex. Basel III came in response to the 2008 global financial crisis. It strengthened the rules by increasing the minimum common equity tier 1 capital to 4.5%, adding a capital conservation buffer of 2.5% and introducing the counter-cyclical buffer which varies based on the economy. Basel III also introduced the leverage ratio to limit excessive borrowing, the liquidity coverage ratio to ensure short-term liquidity, and the net stable funding ratio for long-term funding stability. These changes aim to make banks more resilient. Basel IV, also called the final Basel III reforms, took effect starting in 2023. Key changes include the first one, a revised standardized approach for credit risk with more detailed risk weight. Second one, a single approach for operational risk called the standardized measurement approach SMA. And the last one, a new output floor. Banks using internal models must report at least 72.5% of the capital they would under the standardized approach. The aim is to reduce the wide differences in your risk weight assets reported by different banks.
Hi and Assalamualaikum. My name is Nur Adani binti H. Muhammad Mustafa Kamal and my matric number is 01 DKB23F1004. So now let's dive into Internal Capital Adequacy Assessment Program or ICAAP. ICAAP is a process that banks must follow to make sure they have enough capital to handle all types of risks. Instead of just depending on outside rules, banks must assess their own risk and decide how much capital they really need. It helps banks to be more responsible and prepared for future financial challenges. In Malaysia, Bank Negara requires every bank to have an ICAAP under the Basel framework. Next is Capital Adequacy Rules for Islamic Bank. Islamic bank also have to follow capital rules, but they must make sure it's Sharia compliant. Their capital adequacy is based on Islamic contracts like Mudarabah and Ijarah. They calculate risk-weighted asset differently compared to conventional banks. Even though the concept is Islamic, the capital ratio must still meet Bank Negara Malaysia's minimum requirements. Also, special care is taken when handling profit-sharing investment account. And then we go to the large exposure risk requirement. So to avoid big losses, banks in Malaysia are not allowed to give too much money to one customer or a group. This is called a large exposure risk requirement. Bank Negara says that a bank can't expose more than 25% of its capital to a single party. This rule helps protect banks from major risks if that one customer fails to pay back. And last is operation of savings and investment account. In banks, there are two types of accounts that we usually hear about, which is savings and investment account. A savings account is safe, give a fixed return and the money is protected. But in Islamic banks, investment accounts are based on profit sharing. That means there's no guaranteed return. The bank and the customer share the risk and profits. This is usually based on contracts like Mudarabah. Transparency is very important in these accounts.
My name is Nur Aisha Najah bint Rashid. My matric number is F1014. I want to explain about corporate governance. Corporate governance refers to the system of rules, practice, and process by which a company is directed and controlled. It's define the relationship between a company's management, board of directors, shareholders, and other stakeholders. Here we can see the nature of corporate governance. Firstly, accountability. Ensure that company leadership is accountable to stakeholders. Second, transparency. Promote honest and timely disclosure of financial and operational information. Next, fairness. Treat all stakeholders equitably. Finally, responsibility. Management must act in the best interest of the company and its shareholders. Now we move on to relevance of financial service in Malaysia. First, strong governance reduces the risk of fraud, mismanagement, and financial crisis. Encourage investor confidence, which is critical of economic growth and capital market development. Support compliance with regulations, such as those from Bank Negara Malaysia and the Securities Commission. Finally, incentive for risk management, particularly in protecting client assets, preventing money laundering, and ensuring institutional stability. What is Malaysian Code on Corporate Governance (MCCG)? The MCCG is issued by the Securities Commission Malaysia. It serves a set of best practice and guidelines to promote good governance in companies, particularly those listed on Bursa Malaysia, MCCG, introduced in 2000. Next, we want to talk about main objective of MCCG. First, strengthen board leadership and effectiveness. Ensure the board is skilled, independent, and provide strong oversight to guide the company responsibly. Why its matter is to prevent mismanagement. Second, promote integrity in corporate reporting and recognition of stakeholders. Encourage transparent financial reporting and respect the rights of all stakeholders, including shareholders, employees, and customers. Why its matter is to build trust and prevent scandal. Lastly, foster sustainable and long-term business practice. Focus on long-term growth and considering environmental, social, and governance (ESG) factors and managing risk effectively. Why its matter is to attract responsible investors. Now we move on to principle of corporate governance. The main principle under the Malaysian Code on Corporate Governance include board leadership and effectiveness. Board responsibilities must be clearly defined. The board should have the right mix of skill and independence. Regular evaluation of board performance. Second, effective audit and risk management. Establish strong internal audit functions, set up an effective risk management and internal control system. Ensure the integrity of financial and non-financial reporting. Lastly, integrity in corporate reporting and meaningful relationship with stakeholders. Timely and accurate disclosure of information. Engage stakeholders actively and responsibly. Emphasize sustainability in corporate reporting.